A warm welcome to you, my dear children. Welcome back once again to the last session of unit number 5. Unit number 5, or your 5th lesson, accounting equation. In the previous session, we planned to finish this unit, that is unit number 5, but we are doing one extra session with more questions for you regarding the accounting equation. It was decided just to help you, just to make your practice, more on accounting equation questions. Yeah? Right then. We have one question on screen right now. The following balances were shown as at 1st July 2020. Let's say 2020. The following balances are given as at 1st July 2020, Ruanti's business. That means Ruanti must be a business lady. Most of the time we can say she must be a sole trader who's running a business. Alright? And her balances are given as at 1st July, this is July 2020. 1st July 2020, right? And I know that this must be familiar to you. It should look familiar to you. Why? Because we did a similar question in our previous session with opening balances. Opening balances, children. I very slowly and clearly explained to you that opening balances will be given to you in a question where the business is an already running business. I'll repeat. Opening balances such as these balances will be given to you in a question where the business of the question, the given business in the question, where that business is a running business. Right? You get my idea, right? That way, when we consider that this business, which is Ruanti's business, this one too is a already running business. It's not a newly started business. It is not started on 1st July. That means on this date. Okay? Get my point, right? Considering that, we know in a business, in an existing business, in an already running business, there are balances of assets, liabilities and what? Capital. There are already balances. There must be balances for assets, liabilities and capital. Yes. Capital means equity, right? Okay, but just by the first look, we can see many assets and we can see liabilities also. Can you see a capital? Of course, it's on the bottom. If you do not have the capital, if the capital is not given, you know how to calculate capital. You know how to do that, don't you? You know. Of course you know. We discussed how to calculate capital. Using assets minus liabilities. Assets minus liabilities. That's how you calculate capital. The equity of the business. Total assets minus total liabilities. That means, children, if this was not given, it should not be a problem to you. That means, children, if this was not given, it should not be a problem for you. All right? It should not be a problem for you, because you can do the calculation, assets minus liabilities, and get the equity or capital. All right. Having said that, we can move on to the question, kickstart the question after recording the opening balances. Let's see. All right, we have the question right here, and the first 5 transactions, children, these 5 transactions up to here, okay, these 5 transactions, you can see that, right? These 5 up to here is given in the next slide. Okay, we'll start with recording the opening balances. I'm moving to this side so you can better see the screen. You can see the screen better. What are the assets that we have here? We have motor vehicles. Children, we have motor vehicles. Opening balances. We have 500,000. Yeah, we have a stock worth of 200,000. And we have cash. Cash, children. Cash worth of 100,000. A bank loan. Bank loan. Why do I sound scared? Well, I'm not scared. But I always say liabilities are risks. They are risks. They must be paid back. Okay, that's why I use the red color. Bank loan, we have creditors also. Finally, we have capital. Let's record the balances, children. Shall we? All right, let's go forward. Opening balances. Opening balances. Opening balances. Under assets, separate columns given for motor vehicles, stock, debtors, and cash. Under assets. That means we just have to go look at the balances and record the amounts of each asset in the table. Record the balance of each asset. Motor vehicles, we have 500,000. Stocks, we have 200,000. Cash, we have 100,000. Bank loan, we have 200,000. Right? No, bank loan is not an asset. Motor vehicles, stocks, cash. Let's record 500,000. Stocks 200,000. Debtors 100,000. Is that correct? Oh no, we have motor vehicles, stocks, and cash. 100,000. No balance of debtors yet, as at the beginning. Cash is the balance we have here. Cash is the balance that we have, 100,000. Still no debtors balance. Still no debtors balance in the business, right? No debtors balance, children, which means the debtors will be created as we go on. So we'll keep the debtors column, the opening balance blank. Right. Shall we check out the liability items? We have creditors. Before that, we have bank loan. Let's record the balances. Creditors and bank loan. All right, bank loan we had 200,000. Creditors we had 100,000. Is that right? Isn't it right? Yeah, exactly. 200 and creditors 100. So we have recorded all the assets and liabilities. Shall we put the opening capital too? Yeah, why not? We'll put the opening capital too. It's 500,000. There you go, opening capital 500,000. Fine. Finished with the opening balances. All right, finished with the opening balances. We'll go from the first transaction. Owner invested 200,000. All right. Owner has invested more money into the business, right? That's good. That's good. Owner has invested more money. 200,000. Additional capital. You already know, children, that when the owner invests money, that is cash. When the owner invests money or cash, the cash which comes in comes straight to the business, okay? And that is an asset to our business, right? In that case, first transaction, assets increase. Which asset? Cash, 200,000. 200,000. And that 200,000 came from the owner's pocket or from the owner. That means it should be recorded under equity 2 plus 200,000. All right. Now I'm doing a small change here. A small change. You might remember in the previous session, children, in the previous session, we used plus marks and minus marks. Symbols. We used symbols. I used the plus mark and I used the minus mark to show increasing and decreasing. If something is increasing, I used plus. If something is decreasing, I used minus. Here I'm not going to do that. Right? We are improving day by day. We are improving minute by minute in each session. Okay? What I'm going to do here is I'm going to mention the amount or value without any symbol. That represents an addition. And if it is a subtraction, which is a minus, I'm going to put the value within brackets. That is the way of representing a minus value within brackets. All right, let's do it. Again, owner invested 200,000. That means our cash increase. So cash column 200,000. That's it. No symbols, no plus mark, no minus mark, nothing. Okay, nothing. 200,000. And since it came from the owner's pocket, equity also increase 200,000. No plus marks, no minus marks, nothing. New things, right? You're gonna learn new things every day. Every day. Second. Before we go to the second, children, just check whether both sides have been balanced. Both sides have been balanced. The equal mark is here. So this side also there's 200,000 plus, the other side also 200,000 plus, which means both sides balanced. no problem. Second transaction. Paid 20,000 bank loan installment including 2,000 as the interest. Now we are getting a little complex. Right. Let's pay attention to this. Children, we have paid 20,000. That's not a big deal. We know that we always pay. We pay money, we pay cash for expenses. Cash goes out, so cash decrease. That happens always. So we have paid 20,000, but notice this, as the bank loan installment. That is what I want you to notice. Bank loan installment. Is that an expense, children? Tell me. If we paid whatever the amount, if we paid cash or money to settle the bank loan, is that an expense? No, that is not an expense. That is a reduction of the liability. We already have a liability. Where is the liability? It's there. We already have a 200,000 bank loan. That is a liability. This is a liability. Of course it is a liability. Why not? This is a liability. And we are paying money, cash, to settle the liability, to settle the bank loan, because we took 200,000 from the bank. Already it is there. And we have to pay money to settle that. Of course, yes. So that is not an expense. That is a settlement of a liability. Anyhow, cash goes out 20,000. So we will record that in black color. Second transaction, 20,000 should be here under cash within brackets. You know why I am putting brackets? Because it's a reduction, a minus value. Should be mentioned within brackets. Okay. So, you know, children, that when expenses occur, equity decrease. But this is not an expense, 20,000. It is a bank loan settlement. So it will decrease the bank loan amount. First of all, we will record that also. 20,000 will be deducted from the bank loan, yeah. But there is another story. Including 2,000 as the interest. See, this is something that you should know. You should be careful about. Including 20,000 as the interest. As the interest, we have paid 20,000. I'm giving it such an importance because I have seen children getting these things wrong. I have seen. That's why I'm giving it a little bit of an importance. Now here, children, you already realized that 20,000 is paid out. That is true, okay? No doubts about that. 20,000 is paid out. Cash going out. That is why cash decreases here. and that 20,000 is paid out not as an expense to settle the bank loan. So it's a reduction of the liability. That is why 20,000 is again decreased or subtracted from the liability bank loan. That is also clear, right? 20,000 is subtracted from the liability. But what about this 2,000? This bank loan installment includes a 2,000. Pay attention. This 20,000 bank loan installment includes a 2,000 interest. 2,000 interest. Now what does that mean? I'll tell you what it means. It means 2,000 is interest. Interest. Bank loan interest. In Sinhala we call interest poli. Don't tell me now you haven't heard poli gewano. We pay interest to the bank. We pay interest to the bank as an expense, okay, as an expense to our business, and that expense we must bear for the facility of taking the bank loan. We must pay the bank interest for the facility that they provided to us. The facility is bank loan. We must pay an additional amount as an expense. So this 2,000 is an expense, which means, children, out of the bank loan here, how much is really deducted? How much should be really deducted? Is it 20? No. The entire 20,000 is not being deducted from the bank loan. Out of this 20,000, 2,000 is an expense that we pay to the bank as interest. It is an expense to us, to our business, but to the bank it is an income. That is the income of a bank, of course. As O-level children, you should know that banks give the facility of loans to anybody who requires, who is needing financial support. The banks provide the financial support as loans. For that facility that they provide, they charge us an interest. That is what is given here. So children, this interest is a charge which banks take from any business who has taken loans from them. That should be considered as an expense to our business. In that case, not the entire 20,000 will be deducted from the bank loan. That 2,000 must be taken out. Right. Then this amount is wrong, right? This amount is wrong. It should be 18,000. 18,000. Yeah. I hope you got that. But then again, when you look at the way the transaction was recorded, you must clearly notice that. You must clearly notice this. 20,000 is deducted from this side, from the asset side, but from that side, only 18,000 is deducted. So the transaction is not recorded, you know, it is not balanced. What is the difference? Yes, difference is this 2,000. Difference is the 2,000. 2,000 is an expense. Now we already know that expenses deduct or reduce capital. Then obviously it must be recorded under equity. 2,000 as an expense. Now it is clear. 20,000 is deducted from the asset side, cash, and 20,000 is decreased from the liability, equity plus liabilities from this side. Okay, here 2, here 18. Got it? All right. Let's move down to the third one. Purchase goods at 100,000 on credit basis. Purchase goods. Goods are purchased from our suppliers. Goods come to the business, right? We bring goods to the business. So our stock increase. But we don't pay cash. It is on credit basis. Did you notice that? It is on credit basis, children. See? We don't pay cash, which means the cash doesn't go out. Cash don't increase. Cash, it doesn't decrease. Let's first record the increasing of stock because we purchase new goods. Purchase goods means stock increase, 100,000. No plus marks, no minus marks. Mentioning the amount means it is an addition. Mentioning within brackets means it's a subtraction. Stock 100,000. Stock goes up, and since it is on credit basis, cash doesn't go down because we don't pay. That creates a liability, which means it must be under liabilities. Which column? Creditors. That's right. Creditors increase. Creditors increase. All right. I'll draw this line just to let you know that credit basis purchases has created more creditors. Right. Going forth. Paid rupees 50,000 to creditors. Soon after the first transaction, credit basis, purchasing on credit basis, soon after that, we are paying the creditors 50,000. Okay, paying the creditors. Paying means cash goes out, cash decrease, 50,000. Cash decrease 50,000. Creditors also decrease. Owe them. We are paying the amount owing. Paying the amount owing. Not the entire amount, but half of it. Paid. Right, done. Oh no, we have one more. Fifth transaction. Owner gave 200,000 worth of his private motor bicycle to the business. That is one generous owner. It's a generous owner. He provides additional capital, provides additional capital, and he provides his motor bicycle too to the business. Remember, children, I'm telling, we are not the owners, we are accountants. Owner is a separate person. And this person, the owner, has brought in his bicycle and invested that to our business. To the business. To the business, not to our business. To his business. We prepare accounts. We are not owners. Anyhow, we have got a motor bicycle worth of 200,000. So motor vehicles increase. Before we didn't have a motor vehicle, a motor bicycle. Now we have. How nice, huh? Where are the motor vehicles? It's here. 200,000 increase. Right? And since the owner brought this asset increase, at the same time equity increase, 200,000. Bingo, it's done. It's done. Moving on. First of all, let's put the column headers, right? Motor vehicles, stock, debtors and cash. Motor vehicles, stock, debtors, cash. On the other side, what do we have? We have equity and liabilities. Under liabilities, loan and creditors. We have equity here and under liabilities we have a bank loan. Last column is creditors. Yep. It's done. This is the separation line. I mean, the line which separates. Well, no need to draw, but just to make it clearer. Just to make it clearer to you, this is the line which separates the two sides. Just to make it, extra clear. What do we have on the 6th transaction? Number 6, we have sold goods which cost 100,000 at 150,000. Sold goods which cost 100,000, 450,000. That means our stock, obviously the stock goes. The stock goes, right? Stock means the goods we have sold goods. More goods sold. Stock goes. Stock decreases. Here we have stock 100,000 and what should I put? Brackets, because stock goes. That means stock decrease, and decreases should be within brackets. Sold 100,000 worth of goods, but for 150,000. That's a nice one. Profitable transaction. Sold for 150,000, which means our cash increase 150,000. Is it? Is it? Cash increase? No, children. No. If you did that, you're wrong, because it is on credit basis. So it should not increase cash. This transaction does not increase cash. It is on credit basis. In other words, we have sold goods, okay, large stock, 100,000 worth of stock sold, haven't taken the money from the customer. No. That means the customer becomes a debtor. Under debtors, 150,000. 150,000. Why did we put under debtors? Because the customers have not paid us for the goods that they took. Selling goods on credit basis. That means the customers have not paid us. Right? 150,000 on credit basis. That's why it comes under debtors. All right, now I'll go to the next transaction. Okay, paid. Can I go to the next transaction? No. Who noticed? Who noticed that? Tell me, honestly tell me, did you notice that? This transaction is not balanced. The impacts are not balanced. Students who have an intention to get these questions right, to get them 100% correct, you should notice these things. Be careful. This transaction was not recorded fully. Do you or don't you notice this? There's a 50,000 difference here. If 100,000 was subtracted from stock and another 100,000 was added here, to this 100,000 will be balanced. But it's 150,000 here. There is a 50 excess plus 50. The impacts are not balanced. This side there's a 50 excess. So that side on equity and liability side there should be a 50. What is that 50? What is that 50? It is the profit. We have sold goods worth of 100 for 150. There is a 50,000 profit. Paid 10,000 for insurance. Now we know that when we pay expenses, this is the 7th transaction. Oh, right. This is the 7th. We have skipped one row. This should come to the upper row, right? This row should be here. Okay. Right. Moving it up. 100,000 should be here. 6th transaction. 6th one. Sold goods means stock decrease. 100,000 should be here. Sold goods on credit means 150,000. Debtors created, and there's a 50,000 difference. 50,000 difference here. That 50,000 should go to the equity. There you go. Corrected. Rows corrected. 7th. Paid 10,000 for insurance. You already know when we pay insurance, when we pay rent, when we pay salaries, when we pay electricity bills, when we pay water bills, when we pay whatever the expense, whatever expenses, that decreases cash, decreases equity. Which means 7th transaction, paid 10,000 for insurance, cash decreased. Equity decreased. Okay, cash and equity both decreased. 8th transaction. Received 70,000 from debtors. From these debtors, we receive money. We get money from our debtors. Getting money from the debtors. Our cash increases. 50,000, 70,000. But debtors decreases. Because they don't owe us now as much as before. Before they owed us 150. Now 70,000 is paid. It's good for them. Good for us too. Next transaction, 9th. Paid 5,000 from business for electricity bill of owner's house. That is a problem. Isn't that a problem? Well, that is a problem. 5,000 paid, but not a business expense. We have paid 5,000 for the owner's house. That is a private personal expense. You should realize that. That is a personal expense. 5,000 from business for the electricity bill of owner's house. This is obviously a personal expense of the owner. Owner has taken business money, business cash, for his personal use. It is a drawing. That's right. Very good. It is a drawing. Drawings decrease capital as well as cash. Capital or equity decreases. How much should be decreased? 5,000. 9th transaction, right? We don't want to get the rows mixed up again. Yeah. 5,000 here decreases. Again, equity decreases 5,000. We are done this deal. 10th transaction. Received a sales commission income, 10,000. Okay. Just like expenses decrease capital, decrease equity, when we pay for expenses, money goes out. It decreases equity. But when we receive income, when we get incomes, it increases equity. We learned. Remember? How much is the income? 10,000. Cash increase, 10,000. Equity increase, 10,000. Done. Yeah, it's done. Now, there's a little bit of work, little more work, but important work. 10,000 is, yeah. Now children, we must calculate the closing balances. Closing balances. Here you go. Closing balances, see? We must calculate the closing balances. The meaning? Anybody know the meaning? No? Closing balances? No clue? How? Well, it's not that difficult. If you know opening balances, you should know closing balances. See opening balances? We have opening balances. The balances of assets. the balances of assets: motor vehicle, stock, debtors, and cash. On the opening date, which is the 1st of July, as I can remember. There you go. The opening date, 1st of July. The balances of motor vehicles. I'll write 1st of July. We had 500,000 worth of a motor vehicle. We had 200,000 worth of a stock. We had no debtors. We had 100,000 of cash in our till, in our cashier. Likewise, opening balances were given. Opening balances were given. See, all these were opening balances. But now they are asking for closing balances, children. Closing balances. We should calculate. We should calculate. Do the additions and subtraction. Do the additions and subtractions. And we'll arrive at the closing balance, the remaining balance at the end of the month. Alright, motor vehicles. First, let's start with the first asset. First things first. We'll use a lighter color. Okay. We have motor vehicles, 500,000 children to open. I mean, at the opening day, at the first day. First day of the month. We had, okay. At the opening day, on the opening day, we had 500,000 worth of a motor vehicle plus 200,000. Why do I say plus? Because it is given here 200,000, right? And it is not within brackets. That means it's a addition. 500,000 plus 200,000. How much? And are there any more? No, nothing. No more amounts, no more values, no more additions, no more subtractions. That means 700,000. Well, my zeros are going here and there. Now it's okay, 700,000. All right. Motor vehicles, we have finally at the closing date 700,000 worth of motor vehicles. Let's check the stock, this column. Opening balance, we had 200,000 plus 100,000, 300,000. 200 plus 100, 300. On this side, oh, we have a 100,000 deduction. We have a deduction, we have a subtraction. See, 100,000. Which means 200,000 plus 100, 300,000, 300,000 minus 100,000. It's 200,000. Right? Nothing difficult, right? Okie dokie. Stock done. Let's check the debtors. Debtors, children, debtors, of course, we don't have any values from the beginning up to the fifth transaction, no values. Debtors column is totally blank. But from the sixth transaction, the debtors column have 150 here minus 70 here. So 150 minus 70, 150 minus 70, how much? 80,000. Okay, 80,000 is the final balance. Next we have the cash balance, right? Cash balance. Yeah. We have what figures? We have these figures. 100,000 plus 200,000 minus 20,000. So 200 plus 100, 300. 300 minus 20, 280. 280 minus 50. Minus 50, it's 230,000. Alright, you got it. 100,000 plus 200,000, it's 300,000. 300 minus 20, 280. 280 minus 50, 230. But there's more on the other side. 200, let's write down the figure here just to make sure. 230 we had, right? 230 minus 10, 220. 220 minus 70, 150. 150 minus 5. Oh, this is not a subtraction, children. See how we go wrong? It's not a subtraction, it's an addition. This 70,000 is an addition. This is 70,000 right here. It's an addition. 230 minus 10. 230 minus 10. Within brackets means minus. 230 minus 10, 220. 220 plus 70, 290. 290 minus 5, 285. 285 plus 10, 295. 295. The final balance is 295. We are almost done. Now we have the equity balance. We have the equity balance. Let's do the calculations. Going to the beginning again. Equity, we had an opening balance of 500,000. 500 plus, there's a plus 200 here. 500 plus 200, 700,000. 700 minus 2,000. Yeah, there's a minus 2,000. Yeah. Third transaction. No, second transaction, right? Paid 20,000 bank loan installment, including 2,000 interest. Ah, yeah, that is an expense. That is why 2,000 is minused. It's minused. 500 plus 200,000, 700,000. 700,000 minus 2. 700,000 minus 2. 698,000. 698 plus 200. 898,000. Going forth, going to the 898. We'll mention that amount here. We'll mention it in blue. 898 is the figure that is brought forward to this slide. 898 plus 50. How much? 898 plus 50. 948 minus minus 10. 938 again minus 5. 933. 943,000. You do your additions and subtractions and it's done. So the equity final ending balance is 943. Let's finish it off by checking the liabilities from the beginning. We have bank loan 200,000 and from that minus 18. 200,000 minus 18. How much? 182. 182. 182 from this chart. Let's brought forward to this chart. 182 and there's nothing. That means 182 is the final balance. Done the deal with the creditors. We are done with this deal once we calculate this, the creditors final balance, closing balance. 100,000 plus 100,000, 200. 200 minus 50, 150. Is that it? Yes, 150. There you go, children. Calculation of the closing balances of the business at the closing date. If you want to check what is the closing date, we'll go back and check the question. Following balances were shown 1st July, that is the opening date. Following transactions occurred in July. So this is 31st of July, 7th month. Likewise, children, we are done with recording the impacts of transactions. We recorded so many types of transactions: capital investments, drawings of the owner, incomes, expenses, purchases on credit, sales on credit, and cash purchases and cash sales too. You could get any transaction out of these transactions that we did, any transaction, or new transactions that we haven't done. Whatever the case is, you should be able to figure out, children, how these transactions affect the assets, liabilities, and capital of a business. All right, what's next? Oh, more transactions. More transactions. Well, we have done already 2 exercises. Is this another one? Following accounting equation of Aloka's business shows the impacts of transactions. All right, impacts are given. So what do you have to do? What are they asking from you? Let's check. Owner has not made any drawings. Transactions assumed to be taken place on each day can be presented as follows. That is the case now. Children, this is another way of giving you a question from the accounting equation. All right, they are gonna give you the opening balances already recorded. Bingo. Well, that is easy, isn't it? They are gonna give you the opening balances already recorded. See, opening balances. See, they have already recorded the opening balances. We have 1 million of 1 million of land and buildings, 300,000 of a stock, 200,000 worth of debtors, 300,000 worth of cash. All right, and 500,000 worth of a bank loan, 100,000 of creditors. Then they have calculated the equity also. Assets minus liabilities. Equity is this. 1.2 million, 12 lakhs. They are giving you all this information already recorded under the accounting equation. It's already recorded, children. What do you have to do? You have to guess what transactions has happened. That is something else, right? Let's try it out. What transactions has taken place? Well, I'm not going to write the transactions. I'll discuss with you. You have to do this. It's up to you. Okay. Let's check the first one. 1st March. Aloka's business. Aloka. It's a nice name. Aloka's business. First transaction. Stock has increased by 200,000. Cash decreased by 100,000. Again, creditors increased by 100,000. What has happened? You tell me, what has happened? No. No, it's not me who's gonna go for the exam. You're gonna go for the... Who's facing the exam? My dear students, you are gonna face the exam. You have to tell me. If stock has increased, which means it is a purchase of a stock. Purchase of a stock. This is a purchase of a stock. We can take it as a purchase of a stock because we have already spent 100,000 worth of cash. That means we have paid 100,000 for this stock. We have paid 100,000 for this stock. But only half of the value now. Paid in cash. Half of the value. The other half is for credit. See how the creditors have gone up? That's how you guess what has happened. So what you write is purchased a stock of 200,000 and paid only 100,000 in cash. Rest is on credit. Or you can say it in another way. Purchased a stock worth of 200,000 and 100,000 on cash, 100,000 on credit. That's it. Use your imagination. Alright? I'll write down the first transaction for you because I always do. I'll write down the first transaction. Alright. This is the first transaction. Transaction number 1. Purchased stock of 200,000. Don't forget the rupee mark. Purchased a stock worth of 200,000. Since the stock has increased, I'm assuming that the 200,000 worth of a stock is purchased. Okay, because the stock has increased. Okay, so I'm assuming that 200,000 worth of a stock is purchased. Out of that, you can write, comma, 100,000 for cash and 100,000 on credit. That's how you assume what transaction has taken place. That's that. End of story. First transaction done. Okay. Just to help you out, I'll do a few more transactions. Rest is up to you. Well, These are in your textbook. These are the exercises which are in your textbook. So you can do the exercises, the example activities, and check, cross-check with the textbook. Okay. Then check what do we have next. We have next this one. 7th of March. This is 7th of January. We have a cash decreasement, equity decreasement. Cash has decreased 20,000. Equity has decreased 20,000. Well, I can guess something like this must have happened. Oh, maybe the owner has taken cash. It must be a drawing of the owner. And I move down the question and I notice this. Oh, they have said, they have mentioned clearly that the owner has not made any drawings. It is not a drawing. Owner has not made a drawing in this month. Then what could this be? 20,000 minus cash, 20,000 minus from equity. What transactions decrease equity other than drawings? You are right, expenses. You can write whatever the expense, whatever expenses that you can think of. You can write paid rent of the business, 20,000 in cash. Paid electricity bill of the business, 20,000 in cash. Paid insurance, paid salaries, paid advertising expenses. Whatever the expense that you can think of. 20,000 expenses paid in cash. Just write whatever you can imagine. All right, we'll take one more from around here. 14th of January. $200,000 decreased from stock, 300,000 increased under debtors, 100,000 increased under equity. What could this be? Take a guess, any guess. You son, can you take a guess? 200,000 stock has decreased means we must have sold goods, stocks going out, so stock decrease. 300,000 debtors increase, that means the stock must have been sold on credit. Cash has not increased, see, no cash increasement. Stock must have been sold on credit. That has created a debtor. And there is a difference here. What is the difference? 100,000 difference. 200 worth of stock sold for 300 means 100 is the profit. This is the profit. So you can write this transaction. That is the transaction number 3. No, that is the transaction number 4. You can write this one. Sold goods worth of 200. Sold goods of 200 for rupees 300,000 on credit, and made a profit of 100,000. Even you can just omit this part. You don't have to write this even. You can just write sold goods of 200,000, worth of 200,000 for 300,000 on credit. Done. Children, do these exercises. These textbook exercises sometimes come in your exam paper. Yeah. Some transactions or some parts of the textbook exercises come in your exams. So do this completely. Assume the transactions which has occurred up to the 25th. Up to here. All right. Shall we move on to end this lesson? Situations that can change equity. Well, now, there's nothing to learn. We have already discussed about these things or transactions which can change equity, the capital. What are the transactions? Introduction of additional capital, owner's drawings, incomes and expenses. These situations or these transactions could change capital. By studying the above facts, the facts that we did in the exercises, you may have understood, yes, that these transactions affect to increase or decrease the owner's equity. These transactions. Right. Okay. You tell me, introduction of additional capital, will it increase capital or will it decrease capital? Owner bringing in more capital to the business. Remember, we are not the owners. Owners are separate people, separate from the business. They are putting in more and more cash to the business. Some children think, oh, we are putting in more cash. That means the cash we have decreased, right? Because we are giving our money to the business. No, we are not the owners. We are in the business. We are accountants. Owners put more money. That means the capital in the business, equity of the owners inside the business, equity of the owners increase when they put more and more. But when they take the money in the business for their personal affairs, for their personal use, that is a drawing. That decreases the capital in the business. What about incomes? When we get incomes, to the business. Incomes or profits, of course. More incomes we get, more profits we get, gets added to equity. That means increases equity. It increases equity, but expenses happen. When expenses happen, it decreases equity. All right. Now, get this over with. To get this over with, owner has to invest cash or other assets according to the needs of the business. It increases the equity. Owner may withdraw money or other assets for his personal use. Drawings. Drawings decrease capital. It decreases the owner's equity. Owner's equity means capital. And we have a calculation. Equity is increased by income and decreased by expenses. We have already done. The book is late. Following are some details of Binuri Enterprises for the year. Details are given, children. These details are given. Okay. Opening capital. This is the opening capital. It is 358. All right. Expenses. Expenses decrease capital, right? Yeah, expenses decrease capital. So 128,300 expenses decrease capital. Income. They have given an income that is 254,000. It increases capital. Finally, they have given additional capital invested, cash invested by the owner. That also increases capital. You calculate the final capital. A simple addition and subtraction game. 358,000, that is the opening capital, right? And the additions come next. Additions come next. What are the additions? Blue. Additions. 254 add and 75 add. You get this 688, and then comes the subtractions. Minus the expenses, that is this. All right, minus the expenses from this amount, and you get finally this answer, which is 559,820. Owner's equity as at 31st of December. This is the closing equity. All right, closing. Bingo. Children, calculation of opening equity and closing equity. All right, I hope you understood all the things that we have done today. Finally, we learned that additional capital and incomes increases capital or equity. Plus to equity, and expenses decreases equity. In addition to that, drawings also decreases equity. That's how you can calculate by adding and subtracting the final capital, the closing capital of a business. So, my dear students, with that we wrap up this session and unit number 5, the 5th lesson in your syllabus, in your textbook, accounting equation. We did so many exercises and a lot of calculations. I hope to see you with the next lesson, that is the dual impact of transactions, or in other words, I would say double entry in accounting. We already learned how the dual impact is done, the dual impact, how it is recorded under accounting equation, 2 entries, sometimes 3. And you know by now that every transaction has 2 entries two impacts under the accounting equation. In the next lesson, we are going to put these entries into accounts. Right, children? I hope you enjoyed today's session, and I hope to see you with our next lesson. That is Unit 6, Dual Impact of Transactions. Good luck. See you soon.